Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. Sitting across from me, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, which are a multinational asset management company. And of course, for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to our next instalment of Nucleus Insights, and today we're going to be talking about megatrends. Really looking forward to this one. It's a rehash of one that we have done in the past, but we thought we'd bring it up to speed. So off we go. We've got an agenda today, and what we're going to look at first is why worry about long-term trends, how to use them, what are the key long-term trends, and then of course how we use them every day in our investments at Nucleus Wealth. The trends simply put are rising inequality, baby boomers, women in the workforce, world debt, and company tax rates, and then finally we've tacked in there world trade as well. So with no further ado, we'll jump into it. I've got sitting across the table from me here, Damien Klassen, our Head of Investments at Nucleus Wealth. Welcome, Damien.
Thanks, Jim.
And so I guess we might as well kick off with the question, what is a long-term trend?
Yeah, thanks. I mean, it's obviously what we're looking at from the investment perspective is some of the sort of overarching things that are going on sort of at a level over sort of 30, 40, 50-year periods that are sort of relentless trends. And if we look at, say, demographics as one of them is we've seen a rise of women in the workforce, for example, is one of our longer term trends. And that's been pretty relentless over a period of sort of 30, 40 years. If you look from time to time at if you look at sort of certain periods where you go through recessions or things like that, then what you'll find is that that trend will disappear for a little bit, and then it will reappear as you come out the other side of that recession. So women's jobs might drop off as that recession, but sure enough, the trend's still there once you come out of it.
Okay.
And one of the key things is with these trends is they do influence your investment philosophy over long periods of time, but you can lose money on them for long periods of time as well, for years, I suppose. We're talking about multi-decade trends, and so it's an ever upward march or an ever downward march for these things, and they will certainly affect you. But on a year-to-year basis or a month-to-month basis, these aren't the things you're out day trading on.
So it's a bit of a case of you might be right, but just not right now, sort of thing.
Yeah, absolutely.
Okay. Yeah.
And so sort of keeping that whole trend in mind, but then reacting to either prices or current economic events.
Okay. Sure thing. Okay. Well, look, let's kick off with our first one today. Trend number one, which is rising inequality. So we might need to just define that, because inequality can take on many forms.
Yeah, that's right. There's probably the biggest form is your incomes versus assets. So incomes is in terms of do the incomes accrue to the top 1%, or do they accrue more broadly across to everyone? There's but you can also look at it from an asset perspective as well, in terms of I think you'll certainly see some arguments recently from people talking about, well, income inequality hasn't been as bad as it's been in the last few years, and you're sort of justifying from that. but asset inequality since the financial crisis has certainly increased in that what we've seen is the fall of yields and increasing asset prices generally benefits the richest people who have lots of assets, and the poorest people who are living sort of check to check or paycheck to paycheck don't benefit from those.
Okay.
And so I think that as far as I can tell, it's certainly not getting any better from that perspective. There's sort of some you can pull out. You can cherry pick from some examples, but there's been this sort of trend for about the last sort of 50 odd years, and there's a graph we've got showing there in terms of the levels of inequality, and for the top, this is an income for the richest 1% of the population, and you can sort of very clearly see that that's just been churning higher and higher over that sort of 50-year period. Now, how does that actually manifest itself in terms of investment perspective? Is that you get this low demand. So what tends to happen is if you give a rich person another $1,000, they throw it on the pile and it gets saved or invested.
Sure.
If you give a poor person $1,000, it goes straight out and gets spent. Mm-hmm. And so what you find is that in economies where you start to have large levels of inequality, what you see is a lack of demand. And so there's lots of money out there for an investment. That's available to be invested.
Okay.
But we see what we're seeing at the moment. Interest rates get very low.
Like money becomes very cheap and plentiful.
Yep. And people aren't out there investing in these new CapEx projects because they're not sure that the demand will be there once they actually build them.
Okay.
And we end up with lots of spare capacity because it's investment's cheap and so people invest and that's pretty much where we see ourselves in a lot of the case for at the moment. And for me, this is the big one in terms of driving. This sort of drives a lot of the other trends. So. One way of getting around this inequality perspective, and we've certainly used that, and probably will use it again over the next sort of 5-10 years, is that if you can convince the poorer people to gear up and to give them a lot more debt, then you can get around these demand issues because yes, they're not earning enough money to go out and spend it, but if they can borrow it and go out and build a new house or whatever with that money, then you can disguise the lack of demand for a while
through consumption, essentially.
Yeah.
Okay.
Through borrowing to fund consumption, and that's what we've seen. Globally, there's been a large part of that.
Okay.
Some of the other things that it does start to so when you get rising inequality, political instability is pretty big. And we've certainly seen recently, there's plenty of whether it's the Trump or in Europe, a number of sort of the more extreme parties have risen up, and now in Italy we've got both Italy and Greece have seen parties that were complete outsiders are now in power. Mm-hmm. We've seen even in France, there's the Sarkozy is sort of came straight from. The current French president sort of came from the very much from left field and wasn't from one of the traditional parties there. We're seeing Brexit in Europe. So this rising political instability in that people know something's wrong, but they're not quite sure what the answer is. And there's always a politician who stand up happy to say, "I've got the answer."
Yep.
I think the discontent with the current political situation, that's probably a big thing for the rise of Trump was some of it was obviously a vote for Trump, but I think a lot of it was a vote against a Clinton who'd been there before and husband had been there for 8 years and there's obviously a few Bushes who lost out to Trump as well in their bits, and there's just a bit about we don't want more of the same, and
that just makes sense, I guess, because as you were describing here with inequality, as people are becoming upset with the status quo, essentially they're just going to be reaching to anybody who can offer a second solution.
Absolutely. We know something's wrong, we're not quite sure what it is, and more of the same isn't going to fix it.
And I guess then from an investing standpoint, how does that translate into the way that you look at it, the way that you look at companies and sectors, and is it a case of obviously then what's worked in the past probably now won't work in the future with these rapidly changing landscapes?
Yeah, a little bit. I think this is the trend. When we see this turn, will be a great sign in terms of more demand and things like that.
Okay.
I think for me, a lot of the talk about we're just about to get this runaway inflation, and we're just about to everything's all pent up, and it's all about to change, and interest rates will be back to where they used to be, and everything will be normalised.
Mm-hmm.
To me, doesn't ring true until we fix some of these underlying causes. And so I think certainly over short periods of time, there's things we can do, and whether it be that you give massive tax cuts to everyone, or you go and spend a lot on infrastructure, as long as somebody's gearing up to spend the money, we can hide the effects. But
someone's got to pay the piper at the end, though.
Yeah, in the end, a debt is a definition. In one way is that there's people out there doing work, and whether you pay them, whether they get paid to do that, or whether the money gets borrowed and then to pay it.
It needs to be paid back. Yeah.
Yeah. It's each person earns an income, and whether you underpay those people and let them gear up, let them earn debts, or whether you actually pay them a higher amount. And so wage inflation is probably one of the key ones that we use in terms of that.
Okay.
I mean, it is also worth noting that your technology is not helping this. Liberal capitalism sort of took a bit of a swing from the 1950s, where there was a lot of state-owned economic entities that got gradually privatised, and a lot of benefits from those. But the pendulum kept on swinging and kept privatising. And we were just talking in the last week about how some of the biggest profit gainers have been companies like Transurban, who effectively got a monopoly over a bunch of roads that traditionally would have been owned by a government who collected tolls on it because they're a monopoly asset. But
sure.
But it's a private operator getting these nice chip ups in fees all the time.
Yep.
Sydney Airport's taking a once government asset and privatising, and again it's a monopoly asset. And, there's a lot of talk about all the a lot of the power, how much money people are making from power, and how much of it's all about gaming the system and getting higher rates than what the regulator had, and again these monopoly assets.
Okay, that makes sense.
Yeah. And so the question is, in terms of this, has that pendulum swung too far and actually needs to swing back a little bit the other way?
Yeah, okay.
Just to sort of even things up a bit.
Yep.
And ironically, the fall of communism probably helped a bit in this whole inequality part, in that prior to the sort of fall of communism, there was this part about you need to make sure that everyone's getting paid, and especially the poorest workers are actually advancing, because otherwise you might see an uprising and your country will end up being communist.
Yep.
So I guess
interesting.
There's an argument that constrained capitalism, it's not capitalism that's the best method of is constrained capitalism. That's where you're making sure that the poorest people. And so the fall of communism almost went, well, we don't need to worry about the poor people now because they're not going to go to communists, so we can, we
can step on them.
Yeah, that's right. We can take, they can have their no real wage growth for years and years and years, and CEO salaries can skyrocket, and that's just capitalism at its best.
Yep, and everyone's just going to accept that, I guess, essentially, to a point.
To a point, absolutely. And so this trend isn't reversing in my opinion at the moment. There's a lot of talk about it, but we had this the 1% popped up for a while there post the financial crisis, and a lot of complaints about that, a lot of protests, but that sort of pretty much died away, and so we're probably at least one more crisis away from getting any decent resolution. Okay,
all right, fantastic. We'll jump into our second trend, which is baby boomers. So the second most beaten up age demographic after those avocado eating Gen Ys, millennial whinging Gen Ys that can't afford houses. But I'd be fascinated to hear what you've got in terms of trends for baby boomers.
Yeah, so the key thing with baby boomers, we've got this is a demographic chart. So I've got some demographic charts up, and what they basically show is that post the Second World War, there was this huge influx of births, and what that meant, and gradually as that cohort, which is much larger than other sort of segments, has been getting older and older. Then what you've been finding is that you basically, an investment idea is to chase whatever they need next, and if we jump to the next slide, sort of probably spells it out a bit more, is what it's showing here is the dependency ratios, and it's the US, very similar in a lot of countries, But the idea is that the dependency ratios is how many people are working versus how many people are not working. So how many workers are supporting non-workers?
Sure.
And what we saw within that was when the baby boomers came out, there was all of a sudden this
baby boom,
and so you've got a lot fewer workers supporting a lot of young people and a lot of kids. And then over time, as those kids came into employment, that was actually this huge demographic benefit of you went from having a dad with 3 kids, and he was supporting all these 3 kids, and maybe he's work part time.
Sure.
And as those kids grew up and they got jobs, all of a sudden we've got 3 kids and helping out.
Yep.
And that sort of went on for a long period of time. And that's been a real driver for the last sort of 20, 30 years, is that demographic benefit as we've had of just that increasing workforce and this huge bit. And now, though, the baby boomers are starting to retire. There is a little bit of a bubble coming sort of through the next set of the millennials and Gen Ys. There's a little bit of demographic benefit there, but one of the issues we've got now is the baby boomers are actually living a lot longer, and so now we've got this category sort of falling in. So the dependency ratios are starting to rise again after falling for a long period of time, because now we've got a lot more old people that need to be supported by the current set of workers.
Sure. Yep, that makes sense. Okay.
So it was a demographic trend that sort of drove for years and years and years, but now now we're at the stage where that demographic trend is reversed and starting to make it to make an issue for investments. And so somewhere like Japan is a great example, where Japan doesn't have very much immigration at all. Yep. And a relative low birth rates, and so they've been through that issue of that falling population and the issues that starts to have on a population.
And I guess given that, I guess in a sense, is Japan an economy that's sort of just like looking into the future? Is it literally like we can immigration problems, I guess, or the immigration topic at all, but is the Japanese economy essentially just is that something that you can use as an investment manager as a bit of essentially a guidebook?
Absolutely. Yep. And especially for I think China's a lot more like Japan than many people realize, in that Japan sort of had this huge capex boom that sort of drove a lot of its growth. And then the capex bust and the lost decade that turned into 2 lost decades, and was also wasn't helped by the demographic issues. Yep. Is China's actually in a very similar bucket, in that they have a one-child policy, or had a one-child policy. Yep. And that sort of went from being beneficial. They call it the 6-pocket theory, where you say you've got a grandparent on each side and a parent on each side, which gives you 6 pockets, all sort of pumping money into one child. Yeah, okay. And growing them up. Yep. But then it reverses in that you've got one child now, because he's not got no brothers or sisters or anything like that, needs to start supporting the other end. Yeah, so the dependency ratio completely flips on its head. Yeah, and it's a 6-pocket theory, but in the other way around, you've got one child supporting six pockets, six pockets of grandparents and parents who have since retired, type thing. Yeah, fascinating. And potentially married to somebody who's got the same issue on the other side. Yep. So okay. Yeah, I haven't heard that one before. That's great. And I guess just finally, so from perhaps even just looking locally, we've covered often, obviously big world powers like Japan and China, but our own baby boomer side of things, is there sort of any notes there on the way that it translates into investments, perhaps in the Australian landscape? Look, it's worth looking at groups that are going to be affected by this, and whether it be aged care or was the I'm sure there's an acronym, but it's healthcare, aged care. Depends undergarments. No. Yeah, well, it's talked about in a few years ago that Japan flipped around, and so now adult diapers are outselling baby diapers. Yeah, right. Japan. So there's those type of thing where you might be there's maybe a rise in the people who are chasing those types of markets.
Well, and I think even you've got that you've now got a demographic that's quite wealthy. It's probably the wealthiest demographic in the country that's now having the ability to spend money, probably in a way not seen before in healthcare and preventative maintenance and all these
investment management.
Investment management, yeah, sure,
Yeah.
absolutely. Okay, yeah, sure thing. All right, anything left on baby boomers, or we can shift on?
No, I think one thing on the immigration side, it's worth noting. Look, immigration can help a little bit, but there's obviously a fair bit of backlash about immigration, and the question is about how large does the immigration need to be, and whether there's other issues within it. But I think generally the countries that have got the lower levels of immigration and are going to be more quickly affected by this than countries with higher levels of immigration.
Okay, sure thing. All right, very good. We'll jump into our third one. So trend number 3: women in the workforce. Obviously, there's been a pretty very measured rise. We've got a graph here from 1966 where women in the workforce was, and this is in the US, was 14%, and now it seems to have found its sort of plateau at 51-52% for the last 20 years nearly.
Yep. Yeah. So there's a couple of different ways to measure this one. So I've got a few. I've got two charts on this. One is this long-term stat from the US, and basically it's it's basically looking at that rise. And I think the key thing to note with that is it does seem to have tapered off. There's obviously there's been a big shift from women not working or hardly ever working to into the workforce, and there's been but I think that trend has certainly slowed, and in some countries is actually starting to reverse, which is what our next next.
Okay, we'll jump across to that one. So we've got here Australia, a graph showing Australia and the United States, OECD members, and then Japan from 1990 to 2014. So the United States is on the downturn.
Yes,
probably the most prominent. Remark to draw from that one.
Yeah, that's right. So what we've seen is that's actually starting to reverse in Japan as well. So I think the key thing to note with the demographics is that it's been this great headwind in that women have gone from unpaid to paid, which from a GDP perspective, there's obviously, as plenty of women will attest, they're not doing nothing at home, and there's valuable work being done and all that type of stuff.
That's very well put there, mate. Well done.
But that's right. Shout out to my wife. But there's obviously whether it be technological increases in cooking equipment or washing machines and things like that have enabled people to do more with less time, and so that sort of enabled people to move out of women to move out of that and into a sort of a paid workforce,
sure,
which then sort of makes a big difference to GDP numbers and GDP growth and things like that.
Okay, yeah, of course.
From going to zero to actually something
to
that
doing
registers.
Absolutely,
yeah, something that doesn't register in the national accounts to something that does register in the national accounts.
Sure.
So I guess where I'm trying to get to with this is that this has been this great tailwind for the last 20, 30, 40 years. But again, it's another trend that does look like it's turning, and some of the more wealthier countries started to reverse. Particularly the US and Japan as well, as sort of showing that you can reach a certain level where I guess for people will then actually choose not to work for we're involved in the workforce and then we'll cut back to either part-time or we'll choose that we'll have longer times off for if we have babies, and it's a richer society and where that can be afforded.
And look, I guess that's one of the things, isn't it? That like women in general have just generally got the opportunity to take big periods off in the middle. They have to in some cases, unfortunately. But the other thing I just wanted to draw out of this graph was the fact that Australia's in this little sample here is leading the pack. At up near 59% in 2014, over sort of 50% for the OECD, which is a 20% difference. Obviously, there's been a climb. So Australian women have sort of from the 90s to now, or to 2014, have risen from the 50 to the nearly 60% mark. What could that be from?
You might have to get a demographer for some of that. I think there's certainly issues in terms of I'd put it down to there's some issues in terms of house prices and things like that. That Australia has had quite high house prices for the last decade or so, relative to a lot of the rest of the world.
Sure.
And so some of it's you work because you have to work.
Yep.
There's I think there are countries in the OECD who still have relatively backward views about or policies.
Okay, that's fascinating.
So,
but women in the workforce sort of thing is just not as readily acceptable or obtainable.
And they might not be able to, it might not be as easy for women to get as far. So Australia does have its problems, I think, in terms of gender discrimination, but relative to a lot of countries, it is very progressive.
Okay, sure.
And so you tend to see more progressive countries. It's women will stay longer in the workforce if they think they're being valued and they can progress to higher levels. Whereas whereas if they can't, then there's more chance they'll drop out.
And just finally, there's leading up into sort of pre-GFC 2008, we had sort of Australia and the United States neck and neck at sort of the 58-59% mark. In which case, after that, there's a departure, big fall by the United States, where Australia sort of has held reasonably steady at that rate. Could that just be purely potentially, we'll draw a bow here, but a house price issue, obviously, with the United States having a pretty significant housing correction at that time, and we didn't.
Yeah, but potentially. Yeah.
Okay, interesting. All right, so anything else on women in the workforce? How does that relate through to investment, I suppose? So better tie that in.
So both the demographics and the women is sort of a question about where how fast economy is going to be growing. Okay. So if you're looking at the stage where you can say, okay, we've got this economy that's growing quite fast because we've gone from having say the family, the nuclear family I described a while ago, where we had a husband out working on his own, a wife at home with 3 kids, and then the kids got older and joined the workforce. Well, when his wife joins the workforce as well, now we've gone from one person supporting 4 to 4 people actually in the workforce. Yep. And so now that the family's got a lot more money, the wife can go out and buy more things, which generates more demand. And so that's, if that's reversing and people are choosing, well, look, I can go out and work and earn more money. But if I don't want to, if I don't actually want to spend that money, I've got nothing to buy with it, then I'll just choose to step back and only work part-time and spend what I've got rather than live within my means, rather than going out and working harder to then go and buy more things. So it's one more reason why demand is lower. Okay. All right. Sure thing. All right. Thanks for that. We'll zoom into trend 4, which is always a popular one. So it's on the topic of debt. We've got a quick chart up here on public debt versus private debt, showing a marked sort of wind down of public debt, sort of through the what that be probably the 50s down to the 70s, and then it's in the inverse is sort of happening in private debt land from the 70s up to 2010. So this is Australian debt. Oh, it is, okay. Yeah. So debt of sort of 150% of GDP or so that public debt reached, and now private debt's back up and over that. So basically what we're seeing there is that part of this inequality on the private side is, as I was saying before, if you get this inequality, you have one person out of 10 who's earning lots and lots of money, but can't think of what to spend it on, so he's saving most of it. Sure. A whole bunch of people living hand to mouth. Yep. And there's but you want to be able to, you want those people to spend some more so that you'll generate more demand and employ and be able to employ everyone. Is that the rich person then gives some more, lends money to all those people and allows them to actually get out and spend more than what they're earning. Okay. So that they can still consume. Yep. And the economy keeps ticking over. Sure. So that's sort of where a lot of this debt side has come from. It's also come from debt's changed in terms of it's easier to access. There's been a big fall in interest rates from the 70s up until recent times, and so that means that people can take on a lot more debt. Yep. So it's sort of a debt moves in cycles in terms of these ones. Is that debt gets run up and then it hits a point where you can't spend anymore. And I guess that leads into the next question, that how are we going to pay it back? How are we going to pay it back then? Yeah. So you got 2 ways to pay this back. you got inflation.
Yep.
And particularly wage growth is your big one for that.
Sure.
No good having inflation if you haven't got wage growth. And it's because just seeing your electricity bills go up or your school fees go up or whatever it is.
Just purchasing power in general. Yeah.
Doesn't help generate more demand if your wages aren't going up at the same rate.
Okay.
So wage inflation is the key one, and that's basically where central banks have been trying to go. Is that if we can get interest rates low enough and generate enough demand in the economy, then we can generate this inflation, and next thing you know, the debts won't matter because they'll be inflated away. The other way you can do it is you can have debt forgiveness and or write-offs. So basically, you get to the stage where, let's say that you had a financial crisis, the financial crisis happens and people have lent money to people they shouldn't lend, and you could turn around at the end of that and say, well, look, guys, it was your money, you lent it to these people, you lost it, bad luck, and you write that off, and that sort of gets rid of a lot of the debt obligations, and off you go again.
Quite expensive for anyone that hands out debt, though, I'd imagine.
Yeah, but that's not what happened. So we decided not to do that. So that's happened several times. So in Japan, they sort of had this huge sort of debt run up, and their solution was to create what they called zombie companies in the early 90s, where all the debt was sort of bundled up into various packages, and let's pretend these companies are still all right and they'll last, and then it was just sort of gradually inflated away. Well, the idea was that you'd spend all this money inflated away, but unfortunately they got caught in this deflation trap, and that's basically where they still are 20 years later.
Dear.
The US, we had all these housing loans. Similar type of thing is that government bailouts. There's a lot of people. There's a lot of people who'd lent money to these companies who, whether it be AIGs and people like that, who as debt holders actually ended up getting way more of the money back than what you would think.
Okay.
Just try and make sure that we want to make sure the whole system doesn't come crashing down, let's make sure we bail out these people and keep this whole thing alive. In Europe, similar type of thing. So Ireland's probably the big one there. Is that, Ireland got to the stage and saying, well, our banks are insolvent and we can't afford it, and they were sort of strong-armed by the European Union into the Irish government actually taking responsibility of the debts of the banks.
Wow.
So that which protected some of the sort of the German and French banks from, because they'd actually lent a lot of the money in contagion, in the whole financial system. So you can on one side you can see the argument as like, okay, we don't want the whole financial system come crashing down. On the flip side is there's too much debt in the system, and somebody made the mistake of lending the debt, and so they should bear some sort of responsibility and take some sort of pain. But the option has been declined,
I
guess, by governments, and the idea is that, and so we've seen that. China did a similar thing in the housing markets in the early 2000s. There's it's running up massive amounts of debts at the moment. And I think broadly China is thought that it will step in as well, and if something goes wrong it will step in and bail out the companies, or do the same thing. You take a company onto the government balance sheet and make a bad bank and a good bank, and you let the good bank back out and you let the bad bank run off.
Take out the back.
Yeah, and it's actually China's actually only recently just sort of finished paying off the last housing crash they had sort of in the early 2000s.
Really? Okay.
From as the debt gradually worked its way down, and that's with the benefit of some fantastically high growth rates that they had there.
Okay.
So
and that okay, sure. And so we've covered off. So we've got wage growth and inflation, and then essentially debt forgiveness and creating money out of thin air and handing it to the responsible, irresponsible parties.
Yeah, and so you'd think the wage growth would be easy to get. Sorry. Do you think inflation would be easy to get? We know exactly how to create inflation. Is you print lots of money and you distribute it as widely as possible. The issue is we've set up this financial system at the moment to print money and then to sort of push it out into banks, and then with the idea that the banks will then float it off and that'll sort out everything and that'll get the inflation going. With this idea that the governments are very much trying to, central banks have been sort of given the permission to do this, and that fits under their criteria, but they're not allowed to actually go out and print money. So the financial, without getting too deep into the financial system, a lot of it was set up around, we know we can't trust governments with being able to print money.
Yep.
So let's create these independent central banks and give them rules so that they can do the money printing under certain conditions. But generally speaking, they can print it for short periods of time and you do the quantitative easing, as they call it, which is sort of, well, we've given the money out, but we have to get it back type thing.
Okay.
And so the question there is that Japan's been trying for 20 years. We've seen the US has been trying, Europe's been trying. Nobody can create inflation with this whole quantitative easing mechanism. We're starting to see signs of inflation in the US.
Yep.
But there's a good argument that's more around the fiscal side. If you give out $1 trillion worth of tax cuts, that's a better way of actually creating some inflation.
Absolutely. Yep. Okay.
Than doing this sort of central bank printing type thing. So the central bank printing's been good in terms of staving off a depression.
Yep.
But can it get us out of this and back into a more normal growth perspective by inflating away the debt? And that doesn't seem to be the case.
Okay.
So our big long-term trend of debt increases is still increasing.
Yep.
We're still playing this game, and maybe it's a bit of private debt for public debt switch, or maybe it's just that private debt doesn't fall much at all, or it plateaus, and governments now are the ones that have to gear up, whether it be through big tax cuts in the US or infrastructure spending.
Big deficits. Okay, sure thing. All right, very good. So while we're on the topic of tax cuts, we might as well jump into trend number 5, which is company tax rates. Hang on to your hats, everybody. But how does this one impact as a mega trend for investment?
Yeah, so one of the biggest drivers of earnings per share growth over the last sort of 40, 50 years has been, 40 years, has been cuts in cuts in company tax rates. So they've come down from 50% on average to now below 25. I've got a chart there that sort of shows over that from the early 80s at sort of 50% as the average OECD corporate tax rate, and then just pretty much a straight line all the way down.
Yep.
To 25, and that's pre the Trump tax cuts.
Okay.
And so that'll come even lower, much lower as time goes on. So and we've seen tax cuts in the UK not that long ago as well. Australia is obviously locked in a battle about trying to cut its corporate tax rates.
Yep.
It's this doesn't seem to be a trend that's changing anytime soon.
Good news for companies.
It's a bit of a race to the bottom, I guess.
And in that sense, then, is it good news for investors?
Yeah, it is. So if you flip to the next one, so I've just got a little bit of a table, but basically the idea is that if you look back over the last sort of 40 odd years of companies' earnings growth, they've managed to grow at about 6% in terms of nominal terms. So you take off inflation of almost 3%, so that sort of gives you, a little bit over 3% as how much has actually come through.
Yep.
As real growth, and then if you deduct out the tax cuts, because going from paying a 50% tax rate to going to paying a 25% tax rate is obviously very beneficial.
Half your tax
year
back.
after year.
Beautiful. Yeah,
so that gives you about 1.3. So I guess what I'm saying is of the I think we're 3 and a bit. Maybe 3.3%, 3.4% growth. So you're a third of that has come from tax cuts.
That's amazing, isn't it? Yeah. Yep.
And that's so. I guess putting it another way, if you look at the stock market, especially the PE ratio, a third of the benefit, if you kept that PE ratio the same, a third of the benefit from rising income has literally just been tax cuts.
That's amazing. Yeah.
Which are obviously a sort of, you can only cut tax so far.
Yeah.
But we've got a lot further we can go still.
Yep.
And it does seem as if the pendulum is not swinging back the other way. At some stage it probably will, but in terms of company tax rates, that tailwind for companies of just getting that 1% and a bit every year of tax cuts is alive and well. And I'd certainly look at, say, the US market as well. We're seeing some quite large increase in US profits at the moment, largely because of tax cuts.
Yep.
that'll echo through for another couple of years, because whenever you get a change in tax, everyone then starts restructuring their affairs to how can I best minimise my tax.
Of course.
And so...
Well, it's an Australian pastime. It might as well be a global one, I guess. But
yeah, well, it's very much a global company pastime is minimising your tax.
Sure.
And so a lot of it, we'll see this one. We've got this nice big kick to earnings this year. And then the next couple of years, we'll see companies restructure their tax so that they can get that even lower again. And
just quickly, obviously we've got there an average annual real pre-tax earnings per share growth of 2%. Obviously, it's annualised, or that's over the period.
Annualised over that time period. Yeah.
That, to me, is that a that seems small. I'm just going to throw it. Like, obviously, if you've got, you've made your point there of 30% basically coming from of overall growth coming from tax cuts. So is this a product of competitiveness in the market? Is this just a capitalist market working very efficiently? That there's
the power of compounding. Is part of it.
Yeah, sure.
There's a little bit of that creative destruction side. Companies tend to, I think, I can't remember the exact stats, but it actually works out to be the growth rates are a decent bit higher than that. And then companies do mergers and stuff like that, and tend to destroy a lot of value. And so you can, you can go through. Quite often, it's $1 of profit over here plus another $1 of profit over there, and we put them together, and now we're only making $1.80.
Yeah, okay. Yep.
And but we've managed to cut our cost by even further. Oh, sorry, no, it's not even that case. It's not a matter of cutting costs. Yeah, we've put those together, and it's and yeah. So when you do the numbers in aggregate across all of companies, mergers and acquisitions tend to detract a little bit. But,
okay.
But productivity growth, if you can get to that type of there's obviously smaller companies that grow a lot faster.
Yep.
But you have a system growth.
Yep.
And I guess if you looked at nominal EPS growth of 6.1, if you said, well, GDP growth over that time frame has probably been, I'm guessing a similar number.
Yep.
Possibly a little bit higher.
Yep.
But part of that is some of the larger companies will shrink, and other companies will come in.
Okay, sure. All right, not a problem. And then we'll zoom into our final trend number 6 for today, which is world trade. So we've got a chart up from 1960 to 2015 showing, once again, a nice healthy rise from that's probably around the 10% mark of merchandise trade as a percent of GDP, up to now 50% from relating to the world, I see. So this is world trade.
This is world trade. Just saying, and the magic of trade is that two people come together and both of them walk away thinking they've got a good deal.
Yep. Okay.
And so it's been hugely beneficial for the world economy. There certainly have been losers within the process, and there's lots of questions about how much of the rise of Trump is due to the increase in trade, and we're obviously going through this big issue of protectionism, and is it a good thing or is it a bad thing? And I guess most economists would take the view that protectionism is terrible and it must be stopped at all costs. Mm-hmm. But I think there's also the part about if you would like to transition to an open world trading and you don't protect the people that are going to be most affected by it and find them new jobs, is you end up with these, what you've seen in the US, a lot of Midwest states with high rates of unemployment or and manufacturing bases that are being eroded.
Yep.
The Rust Belt states, as they call them.
Yeah, sure.
And they end up voting in
someone who promises some answers.
Yeah, exactly. Promises to roll back to times from before.
Yeah, okay.
So there's certainly issues in terms of so that's been a huge tailwind again for the last 30, 40 years in terms of this rising trade helping to boost economies. Mm-hmm. It does seem as if this one has turned, and potentially it's turned quite sharply. I guess the question comes back now to Trump's position with, say, Europe, for example, was quite strident at the start, and his position with NAFTA is quite strident, and they seem to be being wound back to something that's more reasonable.
Okay.
The question is the China trade going to be wound back to something more reasonable? There's increasing signs that maybe not. We'll do a full review of that next week.
I was just going to say, stay tuned for next week for our trade war special. So, okay, very good. But I guess just once again, like as per the theme of today, as an investment manager, there's been this sort of, meteoric rise. It's been, it's gone up, many times over in the past sort of, 20, 30 years or 40 years. As an investment manager, is this, how is this something that you can't bank on it anymore because it looks like we're plateauing and now falling away, but how does this relate to the everyday thinking of where you place money?
Yeah, sure. So this is coming back to these trends. Actually, I might jump into the next slide to sort of give you a bit of a broader overview of some of those, which is sort of talking about, it's this idea that the last 40 to 50 years have had basically 5 tailwinds and only 1 headwind. So what I mean by that is that demographically we've seen female participation in the workforce, we've seen the baby boomers moving through, helping with demographics. We've had this increase in debt, we've had increasing trade and reducing in taxes, and every single one of those has gone to helping the economy, grow and be much faster in growth than what you would otherwise have expected.
Sure.
Now those were, by far overcome this issue of rising inequality over that same time period. So rising inequality is taking away from demand. All these other ones are all adding to demand.
Okay, sure.
Now, so for me, it's trying to work out where are we, and it does seem as if a lot of these are all changing now. So we've got sort of how I would categorize it. We've gone from 5 tailwinds and 1 headwind, back to 3 headwinds, 1 sort of neutral and 2 tailwinds.
Okay, so let's work through those.
So headwinds now is the baby boomers. So they've obviously come off their
productive
parts, and they're starting to retire. So that's now going to.
Please don't send any emails over that comment. But anyway, go on.
That's right. So we've got a headwind there. Inequality is still getting worse, and so and it's certainly, even if you're arguing it's not, if you want to try and argue it's not getting worse, it's not getting markedly better, and we're seeing that in wage growth. So that's still a headwind, and trade looks as if it's going to be a headwind. If everything gets resolved nicely, then maybe it's neutral. But I think we're not going to be increasing the amount of free trade that's happening. Okay. So if anything, it's pulling back, and your best bet, I think, out of the whole Trump negotiations and trade war issues is some sort of neutral where trade sort of hangs about where it is. Okay. So that's our 3 sort of headwinds. On the neutral, female participation in the workforce has gone from being a clear sort of tailwind to basically neutral and maybe even a negative. Yep, okay. Well,
as we saw there, outside of Australia, most of them seem to be pulling back now, so in terms of percentage participation, so yes, that makes sense.
Yeah, and then you've got 2 tailwinds that are still helping you out. So corporate taxes. Yep. And so that's, part of the inequality is the cuts in corporate taxes are sort of a bit of the same. Yep. In a way, so that's still certainly going very much ahead. Trump's got his what's through. And Australia's trying to push some through as well. Yep. There's more to come on that front, and the debt's still increasing. Yep. Is the other one. So we've still got this increase in debt. There's obviously some sort of limit to debts, but at the moment, globally debt is still ticking up and increasing, and helping to offset the inequality issues we spoke about. Okay. So from an investment perspective, for me, it's about trying to ascertain demand, and a large part of asset allocation is looking forward to trying to work out. Inflation has been this thing for years and years and years. It's about to jump back out. It's hiding under your bed. It's coming. Yep. And so position yourself for this higher inflation, and we've taken the view that no, it's not coming. This is something that's pretty much dead until we actually see signs that the revival and probably a big government spending, and maybe the US might be successful, but even still, there hasn't been massive amounts of over there. They're probably, you'd almost call their inflation, it's almost normal with a $1 trillion worth of tax cuts. Yeah, right. And so you're saying, well, if that's what it takes to get back to normal inflation, well, are we ever going to see this high level inflation? And
fascinating.
It's an interesting question, but I think for us, we want to see some of the reversals and some of these other longer term trends before we'd actually say that we're into a new burst of inflation.
Fair enough, and it's obviously that then just ties into having someone watching out constantly as well for those that don't wish to do so.
Yeah.
It ties us into our final one, which is how to use in investment, and I guess that can relate to, for people listening at home, how they can use it, but also how we use it, which we've covered in depth, I guess, through the webinar today.
Yeah, so there's sort of four ways I look at this, and just keeping in mind that these are long-term trends. You'll be wrong. Like if you invested only on these long-term trends, you'll be wrong for a couple of years at a time, 5-10 years at a time, before eventually coming right again.
Yep.
So don't take them as this is a rush out and I have to buy something this afternoon based on this.
Sure.
So from an asset allocation perspective, we're expecting lower inflation, lower growth, and so we're keeping that in mind in terms of whether we're in terms of buying cash, buying bonds, and those types of things. From an inequality side, and the debt, is that if the solution to inequality is to try and work out how to get more debt into the hands of people who have got low wages and things like that, then basically we're going to see more debt crises over time. So chances are these are going to be pretty spread out though. So debt crises don't tend to happen year after year, but they're pretty devastating when they do. But so the idea is it's not a panic now, but it's, look, if this is the way we've decided to run our economy, is that we underpay people, but we let them gear up, and then eventually we have a debt crisis, and we somehow reduce that debt, and then we start again. This is a factor of the economy, and we need to factor that in and expect them to come irregularly.
Absolutely.
From a tax perspective, so from valuations, we just need to say, well, if taxes are going to keep getting cut, and we can see where they keep coming through, we need to keep that in mind, that there is some benefit for company earnings just coming naturally from these taxes gradually getting cut. Maybe we'll get a backlash at some stage. I think there's plenty of people who would love to see one, but there doesn't seem to be one brewing anytime soon. And there's a number of companies out there, Facebooks and Googles and things like that, who are pretty good at gaming the global tax system to get their tax bills down. So some of those companies would be at risk if that was starting to generate a real head of steam.
Yep.
So in the back of my mind, from an investment perspective, know which of your companies are exposed. So those are ones where Facebook, Google, Apple are all ones which we own in the portfolio. Yep. But they're ones which we know have got an artificially low tax rate, and if things start to change and we actually do think that'll rise, we need to then reassess the earnings we're using and whether that's going to affect them.
And so I guess on that point, that's where there is sort of like government risk essentially with these large bodies, because they whilst they've probably gained the system to its maximum at the moment, eventually someone's going to turn around and say, hey, you've got to pay tax somewhere or something along those lines.
Absolutely, and there's been a few goes at it, but there's been nothing major and nothing sustained. Mm-hmm. And it's been the case for 10 years or longer for those companies. So it's not you could have said 10 years ago, oh, these companies are paying tax rates that are way too low. They're going to be terrible investments because government's going to wake up and tax these guys properly. But 10 years later, all those stocks are up massively, and their tax rates are either unchanged or down in terms of the amount they're paying. So so I guess the way I look at these is there's a moralistic way of looking at these as, they should pay a fair rate of tax, and I'm wholeheartedly agreeing with that. But from an investor's perspective,
from a capitalistic view,
you have to say, is it going to happen soon? And it certainly doesn't appear to be going to happen anytime soon. If anything, they're getting benefits in terms of taxes from the changes that have been made in the US. Okay, sure thing. And then just finally? Finally on the few, so we've got an asset allocation, there's a debt side to it, and these regular debt crises. The third one is the taxes, and expecting taxes to keep being cut, but to keep an eye on your companies that do have. And the final one is just picking out some sectors that will probably benefit. So there's healthcare is probably the big one. Mm-hmm. So in terms of benefiting from the population aging and things like that, the issue is getting at the right price. So Australian healthcare in particular at the moment is very expensive. So it's a and when you say expensive, it's bitted up PE wise. There's probably two parts to that. There is. It's if you want to buy stocks in that industry, whether it's Cochlear and ResMed and things like that, they are quite expensive. There's an argument about whether some of the private healthcare companies are actually charging too much as well.
Yep.
There is an argument over that, but again, doesn't seem to be enough of a backlash to sort of change things anytime soon. So on the healthcare though, we tend to find we can find international healthcare stocks quite cheaply,
right?
Or certainly a lot cheaper than what we find Australian healthcare stocks.
Yep.
I'd actually urge against that. That doesn't apply though to emerging markets. What we find is emerging markets where most people have got that whole idea. Yes, there's lots of people in China and India who are increasing their wages, and they'll get to a level where they can suddenly afford hearing aids, or they can afford to have their eyes fixed, or these medical procedures that for economic reasons they weren't going through.
Mm-hmm.
They can hit the level, they can hit this income level, and then afford them, and that's why healthcare in those areas will grow particularly quickly. Now that's probably right, though that's already priced into most of the companies within that. So Australian healthcare companies are extremely expensive. Emerging markets, particularly China and India, the healthcare companies we usually find there, the big ones, are very, very expensive as well.
Right.
And so it's actually some of the developed markets that we find that you can dig up some healthcare companies that are a bit more reasonable in terms of the costs.
Okay.
Retirement services is another sort of area, but and there's probably you could probably spend another hour long going through of your various different subsectors that may or may not benefit from some of these trends.
Funeral homes.
Yeah, that's right. There's Invocare, which is a
big one. Yeah.
So the issue though is that again it all comes back to the right price, and keeping in mind these are multi-year trends. So in the back of my mind is that yes, these funeral services are going to grow more quickly than we'd expect over the next 10, 20 years as these demographic issues sort of fall into the right area for them.
Yep.
But that doesn't mean I want to rush out and buy one at overinflated prices at the moment. That's sort of that can be what can be a winning trade, or certainly winning from the profitability perspective over 20 years. May not always line up with the stocks if you pay too much for the stocks up front.
Okay, sure. And so we've spoken a little bit, touched on just briefly there on I guess a value metric in paying over what in an expensive market and paying overs at that point in the cycle, for example. Have you got anything, Dad, just from this trend standpoint, from the other side of our the way that we grade stocks in the quality side? So is there anything you can just pop in from that one?
Yeah, absolutely. So what we tend to do is, we come up with, we've got a matrix where we line all the companies up on a quality axis and a value axis, and then we buy things in the bottom triangle where they're cheap and high quality.
Sure.
But we can stray up so we can pay more we can buy a very high quality company at an average price or above average price because the quality justifies it. And we can also buy companies that are very, very cheap but only average quality.
Okay.
But we tend not to try and mix the two or go into the very low quality stocks or the very expensive ones.
Okay, sure.
So from a quality perspective, when I look at companies that have got these trends sort of following them, we've got a numeric number that comes out. The machine says this is what the quality is in terms of looking at the volatility of its earnings and its margin, looking at its margins and its growth rates and all those types of things. There's an extra there's a little bit of extra credit we give those companies that are in the industries that we like from a longer term perspective on a quality front. Mm-hmm. That and there's ones that in an industry where we don't like the quality aspects of it. Say it's something like a coal stock or something like that.
Yep.
Even though some may rate not too badly on the quality, we'll have this artificial, okay, that's fine, but what's not captured in the numbers is it's a dying industry, and the quality is going to keep shrinking away and things like that.
And so I guess so essentially that's where there is that sort of human element once the model, so to speak, spits out on various metrics that obviously a great place to start, but then it's about going, okay, let's put our trend lens on, for want of a better term, to assess the future of the company as well.
Yeah. Okay. And what I find from my perspective as an investment, when you're letting the models sort of throw out the stocks and then you're applying your knowledge to them and giving them a little bit of extra credit for being on the right trends or the right sectors, the results tend to be better than if you try and go searching for the companies that are in exactly the sectors you like, and you go, hey, here's a great company. Wow, it's really, really expensive, but I love the trend. Let me go and invest in that.
Of course, yep.
They're the ones where you often you find you're overpaying. Whereas if you can sort of go, well, this is already in my sweet spot or close to it, and I'll just give it a little bit of extra credit for being in the right trend and all that type of stuff, but without letting it get so far outside the bounds.
Okay, very good. All right, fantastic. Well, look, on that note, we might just jump into some information. So if you'd like to find out more about how you can get the power of these mega trends and, of course, the investment experience you've heard today in your portfolio, here's some words about Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Okay, so I hope you enjoyed that one today. I certainly did. And if you like that, you'll certainly love, particularly the world trade part, you'll certainly love next week's Nucleus Insights, which is Trade Wars 2.0. So we're going to be jumping back in with some new views in regards to the recent events that have happened with the trade war, and of course how it affects portfolios going forward and how we do our investments at Nucleus Wealth. So same bat time, same bat channel, Thursday the 16th of August at 12:30 p.m. Australian Eastern Standard Time. Head on over to proton.nucleuswealth.com to register your interest for that one. And just finally, of course, we are, as always, available in podcast form on iTunes and wherever your quality podcasts are found in Android. Podcast Addict is one that I know that works. Feel free to just drop in Nucleus Insights in the search. And, of course, today's podcast and all of our recent and prior ones will be there as well. And just finally, thanks very much for attending. As always, we will be sending around a survey if you've registered on proton.nucleuswealth.com for you to give us some feedback on how we've gone today, and of course offer up some new topics for us to research and bring to you. So on that note, thanks again for checking in. I hope you enjoyed it. I certainly did, and we'll look forward to catching you at the next one. Cheers.